Hi everyone, Nikolai here. In this video, we are going to talk about what a wealth tax is and whether or not a wealth tax is a good or bad way to fight extreme levels of wealth inequality. So first of all, what is a wealth tax? A wealth tax is a tax that is specifically targeted at the wealthiest people in a society. Under this tax, people who have a fortune above a certain threshold are required to pay an annual tax that is calculated as a percentage of their total fortune. Norway is one of the few countries that currently have a wealth tax, and in this country, people who own above 200,000 euro have to pay an annual tax that is equal to roughly 1% of every euro that they own above this threshold. Norway is one of the countries with the smallest wealth gap in the entire world, and the wealth tax of 1% is certainly one of the reasons why this gap is so small. However, although a wealth tax seems to be an appealing way of taxing only those who can handle a higher tax burden, this tax does not come without its disadvantages. The Reitan family is one example of a wealthier family who every year is negatively impacted by the wealth tax. The Reitan family owns the grocery chain Rema. However, because they have to pay wealth taxes on an annual basis, this means that they have to sell part of their company every single year, just in order for them to be able to afford the tax. This literally means that year after year, the family owns a smaller and smaller part of a company that they have spent years building from the very bottom. So all of this brings us to an important question. Can the negative consequences of a wealth tax be justified by the fact that it will help reduce the wealth gap between rich and poor? Wealth taxation is mainly advocated by politicians and economists on the economic left. The problem that they are trying to address is that wealth inequality has been growing since the 1980s. Some people see this as the biggest issue facing society, and some see it as an expected development of the economy. The reason why wealth inequality is seen as an important problem is that inequality leads to a host of problems within populations and societies. The effects of low socioeconomic status are staggering. The book Meaningful Differences in the Everyday Experience of Young American Children sheds light on this problem. The environment of low socioeconomic status children is characterized by less dialogue from parents, minimal amounts of book reading, and few instances of joint attention, the shared focus of the child and adult on the same object or event when compared to the environment of high socioeconomic status children. In contrast, infants from high socioeconomic status families experience more child-directed speech. At 10 months, children of high socioeconomic status hear on average 400 more words than their low socioeconomic status peers. But speech and knowledge problems are only a small fraction of the issues experienced by children of low-income families. People from low-income families are less educated, have poorer health, lower life expectancy, and lower income. So how do people from low-income environments react to that disadvantage? People from low-income environments tend to be aware of the disadvantage that they are born into and can become bitter towards society. Low-income environments are plagued by crime and low social trust. In more equal societies, people are much more likely to trust each other. A more equal society will therefore create better and more meritocratic environments for its population, which in turn allows more people to become productive members of society. Wealth inequality is not only associated with social problems, it also has a direct effect on the democratic process. A 2014 study by researchers at Princeton and Northwestern concludes that government policies reflect the desires of the wealthy, and that the vast majority of American citizens have minuscule, near zero, statistically non-significant impact upon public policy. When a majority of citizens disagree with economic elites and/or with organized interests, they generally lose. Economists on both the left and right spectrum acknowledge the problems caused by wealth inequality, but have two different solutions to this problem. Right-leaning economists want to increase economic mobility so people from poor backgrounds can move up the ladder in society. They attempt to do this by making employment and taxation more meritocratic. They're not really trying to reduce wealth inequality directly, as they see it as inevitable. Instead, they seek to give everyone the opportunity to shape their own lives, even those who come from low-income families. So how do left-leaning economists want to solve the problems of wealth inequality? Left-leaning economists want to reduce wealth inequality directly by limiting the wealthiest people's ability to accumulate capital. Thomas Piketty is a well-known economist pushing for the wealth tax. But how does the wealth tax work? The concept of the wealth tax is taxing people on the assets they own. This includes things like real estate, stocks, ownership of corporations, financial securities, etc. This means that the tax is aimed at people who own financial instruments and valuable assets. An example of the tax is British Columbia in Canada. Here the tax has been implemented as a 0.4% yearly tax on the value of homes worth more than 3 million Canadian dollars. This means that the tax is only levied on the people wealthy enough to own an expensive house. So the tax is able to target wealthy people and remove some of their capital each year. Because the wealth tax is levied on wealthy people, it is supported by left-wing politicians such as Elizabeth Warren and Bernie Sanders. But are there downsides to the wealth tax? A simple view of taxation is to look at what is incentivized and what is decentivized. In this case, a wealth tax can be said to disincentivize wealth building and frugality because it essentially punishes wealthy people. The effect of this is capital flight, brain drain, and loss of jobs. Capital flight occurs when assets or money rapidly move out of a country due to an economic event. In this case, people choose to move their assets to foreign countries in order to avoid being taxed. This is pretty much the worst case scenario for a country when a tax levied causes the country to lose money and assets. But are there any examples of capital flight caused by wealth taxation? Until 2017, France levied a wealth tax on assets above 800,000 euro. The economist Eric Pechet estimates the wealth tax earns the French government about $2.6 billion a year, but has cost the country more than $125 billion in capital flight since 1998. Losing $125 billion in order to earn $2.6 billion is a pretty bad deal. France has since 2018 changed the wealth tax to only target real estate instead of all financial assets, because the capital flight caused by the wealth tax is simply not sustainable for any country. So how does wealth tax affect talented people in their home country? Wealth tax leads to a problem called human capital flight, or simply brain drain. Human capital flight or brain drain occurs when talented people or educated people immigrate to other countries because of better opportunities. It is not difficult to understand why productive people will rather work in a country that allows them to keep a larger portion of their own money. Capital flight and human capital flight are problems severe enough to condemn the wealth tax. But are there other problems with the tax? On top of the economic losses caused by the tax, there are also valuation issues. Privately owned businesses account for nearly 40% of the wealth of the top 1%. Assessing the value of a privately owned business is impossible. Publicly traded companies are easy to evaluate, as you can simply look at the trading price of its stocks. Private companies, however, do not need to disclose their financial statements publicly, and they have no clear way of being valuated. Red Bull is an example of a large private company which is owned by two people. The company sold 7.5 billion cans of Red Bull in 2019, and it is safe to assume that the ownership of the company grants its owners a high net worth. It is, however, not clear how to assess the value of the company and their total net worth. So how exactly would a wealth tax be applied to the two owners when their net worth cannot be assessed? Wealth inequality is an important problem, and it is understandable that economists and politicians want to solve it with direct legislation. But unfortunately, in the case of the wealth tax, it is both inefficient, overly complex, and highly detrimental. The tax has also been suggested in the United Kingdom in 1976, but was abandoned because of its poor performance in Spain and France. Thanks for watching the video. If you are interested in economy, or if you want to learn more about which taxes are harmful and which taxes are less harmful, then subscribe to our channel.